Okay, hi there, welcome to a revision blast video. We're going to take 10 multiple choice questions covering aspects of the market mechanism. Great chance for you to have a go at these questions. For each of them, just press the pause button on the video to have a go yourself, and then just press play when you want the correct answer, along with hopefully a credible and clear explanation. So here we go. Question number 1 is about economic systems. Which aspect of a planned economy might be viewed unfavourably by a consumer but favourably by a producer? Press the pause button, please. Have a go at question 1. So, planned economy, where the state directs the allocation of resources. Classic example, socialist systems where the government decides what is to be produced, how and for whom. We think the best answer here is D. An emphasis on the production of capital goods. Well, for the consumer, if a country is allocating more resources to capital goods, that implies an opportunity cost. We may have to sacrifice some consumer goods and services. So that's unfavourable for them. Whereas for the producer, well, somebody's got to make the machinery, somebody's got to install it, somebody's got to build the factories and build the bridges and motorways. So producers typically favoured when governments are spending heavily on capital goods. Question 2. Which statement would be classified by an economist as a positive statement? Have a go, please, at question 2. So we have 4 statements here, A, B, C and D, 3 of which are normative. They contain value judgments, 1 of which is positive. And the correct answer to question 2 is D. The first 3 are normative. Balancing the budget cannot be more important than controlling inflation. Maintaining the real income of pensioners needs to be a priority. The government should increase indirect taxes such as VAT. All of those carry a value judgment and therefore normative. D is positive. It's a statement of economic analysis. A rise in direct tax will reduce real disposable incomes. Question 3. The price elasticity of demand, PD, for a firm's product is equal to 1. The coefficient of elasticity equal to 1 for all price changes. Now, what would be a result of this? Again, press the pause button, please. Have a go at question 3. So in this situation, if the elasticity of demand is 1, then any price change in percentage terms leads to a proportional same percentage demand change, which means that spending by the consumer stays the same, which means that the firm's total revenue will always be the same, whatever the price. It's one of those features of a unitary elastic demand curve. Question 4, the table shows how a weekly consumption of biscuits and coffee by an individual varies with their income. Which statement about the income elasticity of demand over the range of income shown is true? Again, press the pause button, please. Have a go at question 4. Well, looking at the table, income has risen by 50%. $50, however, 150%. The demand for biscuits has increased 0 to 5. That's an infinite percentage change. Demand for coffee has doubled. So that's a 100% change in demand for coffee. So the answer here is A. Pardon me. Income elasticity demand is greater than 1 for biscuits. It's infinity. It's not 0. For coffee, the income elasticity is 100 over 50. It's 2. So both C and D are incorrect. Question 5. The table shows the market for meat, which is initially in equilibrium at quantity X. The cost of producing meat goes up, and there is a trend for consumers to change from meat to a vegan diet. So starting at X, what will be the new equilibrium in the market? Have a go, please, at question 5. Well, the cost of producing meat's gone up, so the supply curve will shift in from S1 to S2. So it has to be A or B. And given there's been a fall in demand as a shift in consumer taste and preferences towards vegan diet, will shift from D1 to D2. So the equilibrium must be at point A. Well, halfway through. Quick reminder, it's really, really worth having good, solid, clear notes on the factors that cause shifts in demand and those factors causing a shift in supply. There are simply loads of multiple choice questions that test your understanding of shifting supply and demand and the impact on market prices. Here's question 6. Goods X and Y are complements. X and Y are complementary to each other. What will be the effect on the equilibrium price and quantity of X of an increase in the supply of good Y? Okay, harder question. Press the pause button, please. Have a go at question 6. What do we think here? Well, we think the correct answer here is D. Let me take you through it. If supply of Y goes up, that's going to cause a fall in the price of Y. And if Y is cheaper, there'll be an expansion of demand for Y. And if people are buying more Y, because X and Y are complements, they'll buy more of X. Therefore, the demand for X will shift outwards, leading to a higher price and quantity bought and sold. Question 7. The diagram shows the market for a good with an initial equilibrium of $10, quantity 100. Demand for the good increases by 40 units at each price, causing the equilibrium to rise to $12, the quantity to rise to 120. This is a calculation question. What is the value of the producer surplus in the market after the price rise? So have a go, please, at question 7. Well, producer surplus is the area below the price and above the supply curve. Let me use my cursor. It's the area below the price 12 and above the supply curve. So it's this triangle here. So you need to know how to calculate the area of a triangle. And it's going to be half times base height. So it's going to be half of 12 times 120, which is half of 1440, which is $720. This is the area of producer surplus here, 720. Are you confident in showing and using the concepts of consumer and producer surplus? Certainly these are key concepts I use with my students. They're important wealth ideas, which if you get to know well, you'll get terrific marks in your answers. 3 to go. The diagram shows 2 production possibility curves for an economy. Now, you've got a series of combinations here. Which combination of movements from letter to letter correctly illustrates these changes in production? Take a moment, please, to have a go at question 8. So, first of all, short-term growth is a movement within a PPF towards the PPF. Effectively, it's an increase in the utilization of existing resources. So the correct answer there would be K to L, whereas M to N is an outward shift in the PPF, and that is long-run growth. So it's K to L, M to N for long run, K to L in the short run, M to N in the long run. L to M, you're moving down a production possibility curve. That's not economic growth, you're just shifting resources away from services towards goods. So the correct answer here is B. Short-run growth is shown by an increasing utilization of existing factors of production, whereas long-run growth means an increase in the country's productive capacity. In other words, a shift in the PPF itself. 2 to go. How are you getting on? The table shows a competitive market in equilibrium in 2 time periods, period 1, period 2. Which of these options, A, B, C and D, could explain the change from period 1 to period 2? The price has gone up from 50 to 60. The quantity traded in the market has gone up from 10,000 to 12,000. So which of these options, A, B, C and D, might explain that change? Again, just press the pause button, please. Have a go at your question and then test yourself. And the answer here is B. An increase in the substitute price will mean there'll be a shift in demand towards this product, causing an outward shift of demand, causing an increase in both price and quantity. Complement has the reverse effect, so to a fall in real incomes. And a tax, well, that causes higher prices, yes, but it shifts the supply curve to the left, reducing the quantity traded. And we have one question to go. Here we go. A manufacturer reduces the price of its goods after developing a more efficient manufacturing process. It makes leather belts that compete against belts made from artificial materials. So what are the likely outcomes of the change in the manufacturing process? What's the likely consequence of the increase in efficiency in producing leather belts? take a moment, please, to have a go just for the last time at question 10. Well, the manufacturers become more efficient, so the supply of leather belts will increase. Now, if leather belts increase supply, the price of those leather belts will go down. Therefore, people will tend to switch towards leather belts and away from artificial belts. Therefore, the demand for artificial belts will fall, leading to a decrease in the price of artificial belts, which is the answer C. There we go. 10 questions on the market mechanism, our little revision blast session. Hope you did well. Hope you got a decent score and it was a worthwhile exercise. Huge thanks for joining me. Take care, everybody. Look after yourselves and see you again sometime soon.